Hello, everyone. Thank you for joining and welcome to this edition of Frankly Speaking, a webinar series where we invite guests to discuss their work and perspective on matters we think are interesting and topical and relevant to our clients and others. My name is Ken Skinner, and I'm a managing director at Morrison Park Advisors, an independent partner-owned and operated investment bank based in Toronto. We're scheduled for up to an hour today. The discussion will go for 30 to 45 minutes, and we'll leave time for Q&A at the end. If you have a question, just type it into the chat box, and if we're not able to get to it, then we'll certainly follow up after. The title of today's session is Addressing the Housing Crisis Through Public-Private Partnerships, which we will refer to as the P3 model. I'm excited to be joined today by two people who are leaders in the use of the P3 model for affordable housing development. Graham Gooch is a managing director at Ayrshire Group, and Ashwin Vadivelu is a director at EllisDon Community Builders. And I should disclose as well that Graham is a client. So if I'm saying lots of nice things about him, now you know why. And don't worry, Ashwin, I'll say nice things about you too.
Awesome.
Welcome, guys, and thanks very much for being on the show.
Awesome. Thanks for having us.
Great. So why don't we start by giving you each a chance to introduce yourself, your company, and your mission. Graham, let's start with you.
Yeah, really appreciate this opportunity, Ken, and nice to be on this panel with you, Ashwin, in particular. Yeah, I'll just introduce Ayrshire briefly and then myself. So Ayrshire is a Calgary-based investment management platform, and it actually originated as a family office for our executive chairman. His name is Phil Swift, and Phil was one of the co-founders of ARC Financial. ARC is Canada's largest energy-focused private equity firm with about 10 billion of capital under management between its resources business and its private equity businesses. But Phil formally retired from ARC about 5 years ago, and Ayrshire has been his principal investment firm since the late 90s. Ayrshire is a town in Scotland where he was born, by the way, just in case people wondering why it was called Ayrshire. So, over the years, our team's always been looking for opportunities to deploy capital into impact investing type opportunities where there's economic returns coupled with social and environmental outcomes. Phil was one of the founding donors of the Center for Social Innovation and Impact Investing at the Sauder School of Business at UBC. And that was about 12 years ago. And there was an incubator research think tank to try to understand how to deploy capital with that impact purpose. So just briefly on me, I joined Ayrshire about 7 years ago. Prior to that, I was working in London, England on behalf of a real estate focused hedge fund. And then prior to that, working with GWL Realty Advisors, who is one of Canada's larger real estate investment management platforms focused on real estate. And we deploy capital on behalf of pension funds and separate accounts across the country. As a team, I guess Ayrshire principals have managed or developed approximately 10 billion of assets over their careers and been principal or advisors on approximately 10 billion of corporate transactions. And I guess what we're trying to do is bring institutional expertise and sophistication to the housing space. Housing is a very archaic model, and it's very fragmented across the country. In any given city, there's dozens and dozens and dozens of developers, and the construction methodologies and systems that are in place to build and manage housing is quite archaic. So we're trying to combat that in a vertically integrated way. So Ken, just to your point, we started working together in the fall as part of Ayrshire's mandate, which is called the Housing Impact Fund 2. And it's a continuation of Fund 1, where there was a number of successful purpose-built rental developments that had impact purpose. And we can talk about some of those as some examples today if you'd like, Ken. But just, briefly, like impact is the thing that we're trying to accomplish. We've been trying to do it for years. We looked in agriculture, we looked in clean tech, fintech, we've looked at office properties, industrial, retail, and it's very hard to achieve as much impact in other sectors that we've looked at versus, housing. Given the volume of support in the sector nationally, you can really achieve a lot of impact in the communities, but also not sacrifice economic returns. So that's why we call it the Housing Impact Fund. And I guess one of the outcomes of today is hoping we can raise awareness amongst private capital to housing space, and then also make Ayrshire aware of people that are developing housing across the country as maybe a source of capital or a partner to help do it.
Well said. Ashwin?
Well said indeed. Thanks, Ken, for having us here, and Morrison Park for kind of creating this conversation, creating the space for this conversation, and great to be on this panel with Graham. As Ken mentioned, so my name's Ash. I work with EllisDon Community Builders. We are the affordable and supportive housing development arm within the broader company. For those of you that are not familiar, EllisDon is kind of one of the largest general contracting and design build firms in Canada. And we do work kind of across the world, but coast to coast to coast. So our group, EllisDon Community Builders, we're relatively new, and we sit within EllisDon Capital, which is the development and investment arm of the company. Prior to starting this group, our group was really formed by a few of us that worked in P3 infrastructure within EllisDon Capital. So really focusing on social infrastructure development, hospitals, courthouses, civil infrastructure, LRTs and the like. And also our group has looked at kind of market real estate development. So we've had that experience working, in pure P3 government sort of credit asset classes where we're developing projects that are providing social benefit to communities. And then we've also been on the other side where we're developing, market communities related to housing. So our group, has been, EllisDon Capital has been probably one of the most prolific P3 infrastructure developers in Canada. We've developed over kind of 25 billion in projects and invested a couple $100 million in these projects. And the genesis of our group was really, we had that great experience, and it kind of happened by chance. A few affordable housing projects were kind of pitched to us, and when we took a closer look at the space, we saw just how much relatability between P3 infrastructure and affordable housing there really was, and the ability to honestly to leverage some of the best principles that we've implemented to deliver billions of dollars in hospitals and critical social infrastructure, and really translate that to the affordable housing space. We thought that there's a lot of great things we could port over. And so as part of that, we made the pitch internally, and EllisDon as a company actually reorged to facilitate that. So our group kind of quarterbacks any affordable housing and supportive housing project across the company. And we have projects across Canada, West Coast, East Coast, and even in Canada's remote communities like Iqaluit, Northwest Territories, Yukon. I know we'll be getting into, I guess, the P3 model and how it's performed in infrastructure, its benefits, and then how it could potentially relate to housing and how we've kind of some examples, I guess, of how we've implemented it. So I'll leave it there for now, but that's us in a nutshell. Thanks for having me on.
Excellent. Well, we have two experts here, and it's great to have you. Thanks again. So I think everyone's aware that there's a shortage of housing in Canada. It's in the media. The politicians are talking about it. Communities across the country are trying to solve the problem. But I'm not sure everyone knows how bad the problem is kind of in aggregate, or particularly relative to other countries that are having the same issue. So I know Graham at Ayrshire and his group does a lot of research into the sector generally in Canada. So Graham, why don't I give you a chance just to talk a bit about the problem like on an aggregate basis.
Appreciate that. Yeah, I think Ashwin, you and I probably have a lot of the same stats, so let me know if I miss anything. And forgive me, I'm just going to be reading a couple of them. It's a big problem, I guess. Just to define what affordability means by consensus across CMHC and a lot of municipalities and nonprofits. Housing is deemed affordable if the cost of shelter is less than 30% of median gross family incomes in that community. Approximately a fifth of Canadians spend more than 30% of gross incomes on shelter. And, obviously in larger centers, it can be north of 60%. And so that doesn't leave much for wellness, sports, recreation, food. So just fundamentally, it's an expensive problem. Canada, as we were talking before this call, it's the lowest supply per capita amongst all G7 countries. In terms of housing units per capita. And so, from an affordability perspective, house prices since 2005 have increased 65% faster than incomes. So People are becoming more underwater relative to their incomes and these home prices. From a per capita perspective, as I said, the housing units per 1,000 Canadians has been falling since 2016, given all the population growth. So if you just wanted to keep the average housing per capita flat since 2016, given all the people moving here, you would have had to develop 100,000 units. In order to meet the G7 average, you'd have to build 1.8 million units. So there's just trillions and trillions of dollars worth of housing. Like if you multiply those units by, depending on the market, $250,000 per unit as a cost base, it's trillions of dollars of housing gap in Canada. And I guess it's getting worse, right? So interest rates have gone up, between 3 and 6 times, depending on what benchmark you're using over the last 36 months. As a developer, I think Ashwin and I are quite similar. We referenced the Canada mortgage bond market. And in January 2021, the bonds were at 0.6%. Currently, they're at 3.8%. And so we borrow relative to the Canada mortgage bonds, probably a 50% spread. So we'd be borrowing in the mid-4s today versus mid-1s 3 years ago. And so that's a problem for developers because they're having to increase rents to accommodate positive cash flow. But it's obviously a huge problem for homeowners as well. It's pushing more people into the rental space because they can't afford a down payment. The median age of first-time home buyers is now 36 versus in the 50s, it was low 20s, right? And so what's happening is in Canada, it takes on average 14 years based on the disposable income across those markets to save for a down payment. It takes 24 years to save for a down payment in the GTA and 28 years in Vancouver if you were to just rely on your own income, right? So obviously a lot of people have help from family and friends. And there was a stat from CIBC where roughly 30% of down payments in Canada come from family members in terms of gifts. Those gifts average $82,000 in 2021. So unless you have help from somebody, you're basically renting forever. It's getting worse. Interest rates are pushing more people to rent, and that's compounding because the developers obviously have less vacancy rates, so they're incentive to push up rents, but then they also need to fund more debt service with respect to their loans. And so it's a compounding effect. And I guess, one of the things we're trying to accommodate for with new housing supply is for all the population growth. There's 400,000 people a year contemplated each year for the next 3 years. And I don't know where 1.2 million people are going to live when a lot of the vacancy rates in major centers are sub 3%. But, I guess the good news is in terms of what solutions that are out there is that there's a lot of appetite amongst federal, provincial, and municipalities to team up together. And I think that's some of the things you were talking about, Ashwin, in terms of like solutions to bring housing supply. And we, I think at Ayrshire feel like we could build a lot more density and a lot lower risk profile if we teamed up with nonprofits, municipalities, First Nations, the federal government. And so there's lots of tools out there to do that. And we're going to, I think, talk about them today.
Yeah, if I could add on to that too, like to your point, Graham, there's a chronic undersupply. And I guess for our listeners, I think the stats Graham and I probably refer to, at least on our end, Scotiabank has some great publications. National Bank as well has as an affordable housing monitor, if you're curious to look up the stats themselves. But I think from what we've seen, so our group has served a variety of clients, nonprofit developers, housing developers, for-profit housing developers, Indigenous groups, municipalities, and so on and so forth. So housing's a spectrum, and there's shelter housing, supportive housing, this sort of mixed market and mixed income affordable housing just for everyday people, and then your typical market rental and market ownership. We've looked at projects across the spectrum, and I'd say to Graham's point, like that supply imbalance has been growing year over year. I think it was around the mid 80s that a lot of the public housing developed by the government levels, whichever level, really dropped off a cliff essentially. And since then, we've been facing a deficit that's been growing every year. And supply right now, I think, is predominantly being put forward by nonprofit groups on a bespoke basis. Kind of, I'll say pot shop, but small 50, 100 unit projects, one-offs across the country at present. And then you have, larger housing developments that include affordable housing as part of it. But that's really the extent of the supply being generated today.
So it's being rightfully called a crisis. And that's why you're seeing so much attention being given to the sector and these programs being developed. So now let's talk more about the P3 model itself. EllisDon, as you've just described, Ashwin, has been very involved in employing the P3 model for the development of all kinds of infrastructure assets. It's been proven successful. So can you tell us how this model works in the context of housing development?
Yeah, for sure. So, I mean, in P3 infrastructure, I guess, to give everyone the general lay of the land within the infrastructure space, if you're developing a hospital, what the P3 really means is it's a government authority wanting to build a social asset. So they're looking to build this hospital. They don't want to take on all the risks associated with developing that. So they engage a private partner, which is the second P in P3. And so they engage a private partner that usually consists of a whole number of companies to take on basically all the risks related to the project or all the risks that they're looking to download. And so that can vary, but typically the principle of a P3 is that those risks are transferred on a turnkey or wholesale basis. So the government contracts with EllisDon to deliver this hospital and maintain it for 30 years. And they're just looking, hey, we're signing you up, and it's a fixed price, fixed schedule design build contract. It's a fixed price life cycle and operation and maintenance schedule over a 30-year period. And it's really turnkey. It's, hand us over the keys and then help us operate it, and off we go, really based on performance and availability. So that, and it protects the government or the client from those overruns, risks of that nature. And the principle is really allocating risks to the party best able to manage them. And that's something, prevalent in finance, that principle. Within the P3 space, there's a couple of variations. So you'll hear the acronyms DBF, DBFM, DBFOM. So what those mean: design, build, finance, maintain, design, build, finance, operate, maintain. What each of those letters mean is essentially a scope that's being passed from public sector to the private sector to take on. And so what we've seen in infrastructure is a lot of government levels of government are looking to transfer all of that risk over. So the design build of the project, privately financing the project, and the operations and maintenance of the project. So you're taking on all the risk wholesale, and we want a working hospital that's available for its community, and it serves its intended purpose. And so P3s have scaled like crazy in Canada, grown like crazy, and we've seen that happen in other more mature markets like UK and Australia. And so shifting over to housing, what we kind of saw was we saw when we looked at the space and how housing was developed, a lot of nonprofit groups, municipalities, indigenous groups are developing housing without a lot of that wholesale transfer of risk. They're building with a lot of that on themselves, and that really inhibits the scalability of development. It really inhibits them from developing 100 units. They have to develop 50 to make sure it makes financial sense. So what we've seen and the projects we've done that look like infrastructure have been closer to the DBF model, where I'll speak to a project we did in BC with BC Housing. BC Housing engaged us for the turnkey delivery of a project, the design build finance of it. So we took on all design build risk and also privately financed it using infrastructure sort of lending and infrastructure terms, sort of that infrastructure investing mindset. And what that brings is sort of value for money because infrastructure is generally more secure, more stable, or better credit risk, and it allows for more efficient kind of financing structure. So to put a specific example to it, but by and large, the principle for P3 within housing is really how can we replicate that wholesale transfer of risk to a party best able to manage it, leverage the scale that the P3 model can bring so we can build more housing for people that need it most. A big principle of P3 is ensuring all risks and costs are accounted for and providing that security to everybody, and really basing it on availability and success. If the housing isn't delivered, the private partner's online.
Okay,
hopefully
great.
I capture that relatively well.
Yeah, no, that's very helpful. And so clearly, we have a lot of content to get through here today, so I'm going to try and keep things moving along. But before we do, one question is on the financing part of that DBFO acronym. I know in many cases, it's arranging the debt financing associated with the project, but does that also mean an injection of equity capital from EllisDon or other P3 players?
Yeah, the P3 project we delivered, we did have equity in it. And I think that's something that's being actively developed in the space. One thing we found, we've opportunistically always looked at projects, and we always bring, the same mindset we had for P3 infrastructure, where it is our own capital, and that appropriate stewardship comes with it. We've brought to this space. But we found is a lot of the public financing programs that support infrastructure or affordable housing development or supportive housing development more so, sometimes require, certain nonprofit status or the inclusion of certain groups. And sometimes having a for-profit investor may mess that up. That being said, I know in the space that Graham plays in, where it's more mixed income, mixed market, it's really a for-profit entity that can inject equity, and it's probably makes sense on a risk return basis, right?
Good. Okay.
Yeah, and you can just, I think fundamentally, like you say, Ashwin, build more supply when you team up with the private sector. And normally the outcomes that you're talking about lower the risk profile as well for the whole project. So we got lots of examples of that.
Yeah, and we're going to talk more about that. And as a matter of fact, we're going to talk more about that right now. So yeah, I mean, there is a well-established market for financing real estate development and housing development. The risks and returns are understood and, mostly predictable, and investors in that market have done well for many years. The standard form of affordable housing development typically means that you're offering some or all of the units in a given project at rents that are below market. And so the question is, all else being held equal, the revenue to that project is going to be lower. The annual cash yields to that project are going to be lower, and the project returns are going to be lower. So an investor naturally wonders, well, if that's the case, how is affordable housing a good investment? And particularly relative to a project that's just at market. So Graham and Ashwin, you've been out there doing this already on a number of projects. So I'll put it to Graham first, but how do you deliver meaningful impact housing, and while at the same time delivering compelling risk-adjusted returns?
Yeah, I mean, I think you hit it on the head, Ken. It's mixed market housing. So in the past, it was always, you would call it affordable housing, and it would stigmatize the building or the location, right? There'd be more stigma, crime, less capital investment into the community because it was, a density of lower income occupants. But I don't know if it's but it's more prevalent now with some of the initiatives that CMHC in particular have offered, is that you would do mixed market housing. So, and say it's a 100-unit development, 20 to 50% of the units can typically be offered at rents at or below the 30% median incomes in that community. And so you can go further on that scale depending on, the outcomes that are offered in terms of lower cost credit, grants, et cetera. But once you do mixed market housing, the units that are for market offset the impact of the discounted ones. So a project at the whole has positive cash flow, rather than having negative cash flow. So, it's no secret the private sector needs positive returns. We don't need huge returns, but we need positive returns. And, you could never participate in affordable housing because it was negative cash flow in terms of the expenses, right, to manage. But now with mixed market, it's positive cash flow. And so we did that. I'll just give one quick example on a property in Edmonton where the federal minister of housing, Honorable Minister Huson, announced a 1% loan for approximately 95% of the costs to develop 250 units. And in exchange for the 1% financing, we had to offer a minimum of 20% of the units at rents below 30% median incomes. And, we were looking back at the decision to invest in that property and develop it. We would have never developed in that community. It just wouldn't make sense because of the risk associated with a lower income community like that. But once you start teaming up with public-private benefits and getting lower cost credit in particular, then it rationalized, and it was great to see in that community the rejuvenation. I don't think the last time somebody developed something new in that particular community was in 1978, and so you're starting to see new supply get developed in areas that really need it when you do it with public-private partners. Now, in that scenario, we were going to do co-investment equity with a nonprofit, but we ultimately did not at the development stage, but we're going to sell it to a nonprofit once it's complete. And so I don't know, I think we really like the mixed market nature. And for us, it was an opportunity to recycle the capital. We're going to go build another one now. Just kind of a quick example there.
Yeah. And so, in this partnership scenario, private sector is bringing their strengths, as is the public sector, and it works well as a partnership, each kind of offsetting each other's weaknesses, right? There are other things that you've told me that a public sector partner brings, and it goes beyond just having projects they want built. There's land positions and grant programs and access to other privileged financing programs. And, oftentimes you're serving a specific community need. So, there's great demand for the product that's being developed. So you mentioned earlier about rates rising, of course. And so how do you ensure that those returns are maintained even in current market conditions?
You want me to start with that one, Ashwin? Yeah, I think almost every line item in a development pro forma has increased materially. And Ashwin would know more than me. But I'll just give a few examples on some of those line items and how public-private partnership benefits can mitigate that cost inflation. So for interest rates, we talked about that property in Edmonton where we would have otherwise probably had to borrow in the mid-4s, but we were able to borrow at 1% if you partnered with the federal government on the debt in that case. So interest rates are lower with 3P developments typically, but they've still at least tripled. So you need to find the right markets and the right structuring. Hard costs are also lowered with the 3P construction because I think in the old days, the public institutions or nonprofits would build product on their own. And that's no secret, I think it's public, that public institutions pay more for the same property than private institutions. There's different systems, there's more overhead, and there's, I think, less efficiency. So when you partner with the private sector, who's like ravenous for return and outcome, it really makes some, you're able to make some lean decisions. And I think in our case particularly, when we talk to nonprofits and municipalities, what they like about Ayrshire is that we're vertically integrated. So we have our own steel manufacturing business. We have a modular contracting business. That steel business is called Complete Framing Solutions. And then Nomadic Modular Structures is a company that BC Housing and some First Nations have used to develop housing in remote communities. And I think when you are vertically integrated, you can lower the margins and that would be earned by other third parties along the way. And we also do our own general contracting. And I think one of the benefits that probably EllisDon brings to a pro forma as well would be that they're doing the contracting, right? They're able to control the whole hard cost pro forma. Just two other quick ones. Land, typically, like if your federal land initiative is a pool of land in the country where you can acquire it from the feds, it's like old, army bases or whatever's on the federal balance sheet. That land typically wouldn't be available for the private sector to buy. But if you're a nonprofit and you're teamed up with the private sector, you can acquire it, and you can do it at a much lower cost base than what it would normally be worth in the market. They only sell it to you for a lower cost in exchange for some serious environmental or social outcomes. So we bought a $2.5 million piece of land for a couple of $100,000 in exchange for building a net zero townhome development, and so you have access to land positions at a lower cost base, and then development cost charges can be waived. And then oftentimes, like if you're working with a nonprofit, they have a wait list of people, so you don't have marketing in your pro forma anymore. It's pre-leased. So we really like the risk profile of 3P housing for a lot of those reasons.
Excellent. Okay, thanks, Graham. So Ashwin, EllisDon, long history of successful development. And, obviously, being successful on any development depends on really efficient risk management and allocation. So can you talk a bit about how you help your project partners manage risk?
Yeah, and it ties a little bit into Graham's last sort of answer there too. Like I think Graham, you listed a lot of the uses of funds or your capital costs and how those have changed in the last few years. One big thing I think our team brings to the table when we're working with a lot of our clients looking to develop housing is an overall picture of the project financially really early on, and look at all those costs, figure out what that cost structure looks like. But then at the same time, look at your capital stack and with a lot of these projects, because of the social aspect to them and the social benefit that they're bringing, a lot of the time you're able to actually get other benefits from municipalities, provincial government, feds, Indigenous Services Canada, at Federation Community Municipalities. Like there's a whole bunch of one of our clients has called it lasagna funding, but essentially it's you got to layer on a whole bunch of different things, and by layering those things on, it actually makes the deal fundamentally different than if you were to just develop housing as a secular for-profit developer. But to your point on risk allocation, one part of it that we like to approach it from, and I guess I'll speak to some of our projects that we've done with municipalities like the City of London or with nonprofit groups and Indigenous groups where they're our client, we're helping them kind of deliver projects from end to end. We like to kind of start off with a holistic view of the project. Figure out exactly, how much equity is going to be required. What are those sources and uses? How do they all tie together? And the likelihood of actually making sure that you're going to get those extra grants or from CMHC or wherever that'll help make the project work. From a delivery perspective, we bring that P3 mindset in. So we look for that kind of wholesale, and our clients look for that wholesale download of design build risk, the CCDC 14. Basically fixed price, fixed schedule, delivery of the project by EllisDon for the client, turnkey, hand us over the keys and off we go. And a good thing with EllisDon, to your point, Graham, I think it's interesting or telling that both of our firms are here because we both are really vertically integrated. We like to design build projects and we'll also operate and maintain them, life cycle them for 30, 50-year periods across the board, whether infrastructure or real estate. So we do bring that to a lot of our projects where we'll not only deliver the project turnkey, we'll also take care of that life cycle risk for you, map out when you need to replace your boilers, chillers, and incorporate that mindset in the design development process. So making sure we're using materials that are long lasting. A lot of our clients are long-term holders. They're going to hold the stuff forever, and making sure that this makes sense from a holistic life cycle basis. I think that's what we'd say, and a lot of the diligence, just by nature of I've seen the process that we bring when we're looking at a P3 project, bringing that same level of diligence and process to this space, especially when we're looking at our nonprofit and municipal clients, Indigenous groups that are looking to build housing, bringing a lot of those principles takes risk off of their backs. So they can focus on operating and delivering housing for those that need it, their tenant groups, and we can focus on what we do best, which is delivering projects successfully.
Excellent. Okay, thanks. So, there's many developers out there now pursuing affordable housing strategies, and meanwhile, the ESG thing is in full swing, and quite rightly, I think people are concerned about greenwashing, right? So I think people wonder about how genuine is it that some of these projects are actually going to deliver on the affordability and other social or environmental impacts that may come with that project. So this one for you, Graham, how do you assure your public sector partners that you're going to deliver on those social, affordable, and environmental and other impacts?
Well, I like with the term you used, the lasagna approach, Ashwin. Like it's you have really hard commitments, right? To in the example where we purchase land from the federal government, there's commitments on title to in that case develop net zero, right? And so you have commitments to the vendor of the lands, you have commitments to your lender in the context of the loan pool, and so it's in three silos, right? Affordability, accessibility, and then environmental outcomes. And so those three silos have very specific criteria that need to be tested, in the future. And So I'll speak to each one of them. I guess from the affordability perspective, you look for median incomes in the community and you make sure that a certain percentage of the rents, whatever dictated by your loan, are below the 30% threshold. And then that sets the rent once the construction is completed. And then those units can only increase at a maximum of CPI. And so the developers are underwriting the returns net of that, knowing that those rents can't, in a crazy scenario, increase 10% a year. You've got to keep them flat. But the impact of that is offset by the lower cost credit, right? And some of the other benefits that we talked about with, other nonprofit partners. From an accessibility perspective, from an accessibility and environmental perspective, those are permanent solutions, right? You're physically designing a building with accessibility metrics in mind. There's the Rick Hansen criteria. There's, other criteria with respect to accessible, barrier-free design, et cetera. So you're building a building that's going to stay there and be designed that way forever. So that's permanent. The environmental outcomes are also semi-permanent because you're committing to a certain energy usage relative to the 2017 energy code and of late. And so you're putting building systems in place that are going to, stay with the building, whether you own it or not, it's going to stay. And the affordability is the only one that would fluctuate. But when we build a building with a nonprofit partner, for example, oftentimes they'll buy us out, right, over the life cycle of the asset or right at, construction completion. And so in those instances, a nonprofit's going to own it, so they're going to have pretty strong community outcomes. If we sold it to a third party that wasn't a nonprofit, they're incented to also provide those outcomes because they want the lower cost credit, right? It comes with a certificate of CMHC insurance. The federal government is guaranteeing the loan. So it's there's pretty strong incentive for the buyer of that asset to also provide rent discounts, and that's one of the things we struggle with. There's a lot of sincerity at our firm to create impact in the community, and we're trying to do it in all transparency while still earning reasonably strong returns. But we're not making a ton of money, right? We're just making market returns and doing it in a way where there's different menu of opportunities with the lasagna approach.
Good.
I think a big, to add on there, like a big part of when you think about, I guess, the P3 model as is for infrastructure in Canada and then housing development, to your point, like that, that CMHC insurance certificate on long-term debt as an example, or it's part of the project. At some level, a big part of what brings that value for money or efficiency in the P3 financing structure allows returns to go lower, allows leverage to go a lot higher, and banks being comfortable lending at high ratios is, the fact that there's municipal, provincial, or federal backing for a project. These are projects that have been deemed as socially important. And I think a big shift was, I think a couple of years ago, Canada actually made housing a human right. So it's like healthcare, essentially. Housing is a human right. It is infrastructure. So bringing that mindset where I think the market's kind of shifting, and Graham's probably on the leading front of it, where you're getting CMHC getting more involved, and they've already been a huge lender to these projects. But I think the next era is going to be getting much more support from those levels of government so that we can actually get kind of more plug and play sort of P3s, if that makes sense. That makes the risk and returns a lot more, make a lot more sense, I think, long term.
For sure. And we've heard from investors over and over the concern around if the impacts that are being targeted are going to last for the long term. Because if you're just kind of trying to qualify for a privileged financing program from CMHC, for example, and it only has a 10-year term, well, what happens in year 11? And so I think based on what you guys have said, there are ways, like some of these impacts are permanent, just given the nature of the asset. But and I think over time, as this model gets deployed more often in more places, that sincerity that you refer to, Graham, will prove out. And so I think there's a lot of desire to ensure that these impacts remain in place for the long term.
Yeah, we survey some of the tenants in our new developments and try to understand, their demographics, their socioeconomics, why they choose to rent there. And it's a really fulfilling thing to do when you're developing housing for people where they feel safer, for example. Some of our investors have different outcomes that they'd like to see in terms of new supply. For example, we've got one of Canada's largest philanthropists in the autism space that's, supporting Ayrshire. And so we'd like to design our buildings where there's a certain percentage of units in that accessibility, framework that are designed for autism. And, those are interesting solutions, light dimmers and different textures. And we just one quick thing. I think one of the things that we struggle with, though, is how to report on it, like to investors or to the community. And I know when we're talking to nonprofits as well that are partnered on projects, what do you reference? Because there's no gap or IFRS or anything, right? So one of the things we have defaulted to lately is referencing the UN Sustainable Development Goals that you can just Google. And so those are common, framework goals that we can report against. And in our case, we're choosing 8 of them, and they're categorized into environmental sustainability, construction sustainability, community benefits, and then affordable housing and social equality. And so we're getting better at it as an industry, reporting on specific outcomes, but there's still a lot of work to do. I think every development is kind of like its own little case study, right? It depends on your partners, what they want to accomplish in the community, and your investors. And so it's a lot more qualitative than it is quantitative. I memean, you can measure the environmental outcomes, right, with respect to GHG emissions and energy efficiency, but some of the other stuff you can't measure as well. So
Yeah, and I think what I've learned from you guys is and what I've also heard from investors is, as people are trying to get their head around impact and what does it mean and how do you track it. I think housing is maybe one of the few assets where those social environmental impacts they're tangible, they're measurable, and they're reportable. And so I think as you said, Graham, as the market evolves, there will be accepted standards for reporting, and everyone will have to live by them. So I'm being mindful of time here, 3 minutes until we're supposed to start a Q&A session. And I want to give people out there a chance to ask questions. So so for the next few minutes, I mean, one other thing worth talking about is, I think what we're learning here is that this P3 model can be very effective for delivering housing, both on both sides of the equation, both for public sector, looking for equity capital, looking for help with project delivery, and for investors who are looking for, good on-market risk-adjusted returns, and perhaps as well getting some social and environmental returns along with it. So from your guys' perspective, it seems to me that this could be, a meaningful solution for addressing the problem in housing and potentially at scale. So what are the limitations on growth? How can we get this going in a bigger way?
I think
Who wants to take that? Anyone?
Yeah, I can take a stab at it. I think from what we're seeing from a project perspective, I think when you look at more mature markets like the UK, Ireland, a lot of them approach housing. They actually issue, it's very similar to our P3 space. They're issuing RFPs. They're looking for consortiums to take DBFOM risk, and by and large, they're pricing off of, they go out to the market and say, who can provide the best value for money in terms of delivering these units, and all we want is turnkey delivery and availability of these units. And they've kind of recognized that in order to address housing, as the crisis that we have, you really got to focus on scalability and using this model to get that scalability. So I think shifting the mindset, and I think it's happening through conversations like these across all actors in the space, moving from singular project discussions and looking at partners and solutions that can deliver on a portfolio basis, multiple sites, standardizing the approach. We're doing projects across cities and across the provinces. The environmental standards are always different. Accessibility, you have to recreate the wheel, so to speak, in a number of areas. sometimes you have to, but on other aspects, should the financing sort of methodology change across the board if it's the same sort of asset class, same sort of risks. So bringing that sort of scalability, standardization to the table in terms of how we procure and deliver housing, I think is sort of the next step. And I think that those conversations need to be had. I think it's a structural thing, though. We got to see a couple projects play out in order for everyone to kind of hop on the boat, and then you'll see more and more traction. That's my take, at least. Graham, I'll pass it to you.
Yeah, no, I don't have much to add. Appreciate that, Ashwin. It's I think raising awareness, like you say, in terms, like these webinars are great. Hopefully there's some awareness amongst the sector that we can team up as a capital solution or a contracting solution, and even just compare notes. I think two primary things, though, just to reiterate. One is mobilizing private capital, and two is raising awareness amongst the nonprofits and municipalities on structuring 3Ps. It's very foreign. Some of this, some of the unique structuring elements are kind of no-go territory for city councils. And I think that can change. Some cities are further ahead than others, and they're comparing notes that we're seeing. But, using, a public-private partnership structure that we've done in Edmonton, for example, and copy pasting that in Ontario, I think is something that we can do more of, because there's a lot of work that goes into, structuring the risk, and we should leverage that, project to project. I think just on the capital front, though, there's so much debt in the system. Like anybody can go and buy some land and borrow from the federal government to build housing. I mean, you generally speaking, you can do that. Sometimes you got to put up personal guarantees or corporate guarantees, but the debt capital is there, but equity capital is a little skinnier, to be honest. Like we've pulled up a fund called Housing Impact Fund 2 that is equity capital to support projects, and we think there could be more of those. I think focused specifically on housing, and part of it is what you said, Ken. And Ashwin too. Housing is infrastructure, and it's got infrastructure like risk. So I think as an asset class, it can perform well for private capital investors, right? Like if you look, MIT did a study that tracked CPI versus total returns in residential rental housing since the 70s, and it's got almost a perfect elasticity. It's like 1.02. So it's a inflation protected income, inflation protected returns, and even on its own, if you didn't have public-private partnerships, but when you bring in all the elements that we've talked about with grants and land acquisitions and lower cost credit and pre-leasing and structured exits, on a risk-adjusted basis, I think the returns are really compelling.
That was a pretty cool stat there, actually. I'm glad you mentioned that. I'm definitely going to steal it. The elasticity one.
Yeah.
But housing as infrastructure, I think that's the big message.
I think so too, and I'm not sure how many people actually realize that. It checks a lot of the same boxes. It's kind of unshakable demand, very well-known costs and risk profile, large tangible assets, low risk, stable, and as you said, Graham, inflation protected cash flows and lots of debt capacity. So I think it'll be a matter of time, but over time, the investment community should be supporting this in a bigger way, and that's what's needed. We've heard from project owners across the country that it's not just about project delivery; it's help with equity capital. There's all kinds of debt financing programs out there that are supporting new development, but equity capital seems to be in short supply. So it's my hope that we can attract the public sector with projects and the investment community with supportive equity capital to get these things done. And if that can happen, then I think this model as a solution can hopefully move the needle on what is now a crisis. So good. This has been really good. I need to switch on to some questions here. So I have one here, which is in reference to regional differences in cost. And I know that in Toronto right now, getting projects done economically, even fully on market projects, really difficult to make the numbers work. But that's that's Toronto, and there are many other regions in Canada, all suffering from higher interest rates, higher costs, and labor shortages. But maybe each of you can maybe just provide a quick perspective on regional differences.
Yeah, Graham, you want to take a stab at it, or do you want me to?
I got a few comments. Sure, I can try on that one. Well, I mean, you need to be. You probably can't even get a formwork contractor or a drywaller in Toronto right now. I mean, unless you're EllisDon or something, and you've got big, relationships. And so you need, I think, to be vertically integrated contractor to deliver housing or any developments in some of these major centers. But one of the interesting stats I just had is like, if you take land, if you look at a pie of costs, total development costs, it's basically land, soft costs, hard costs, interest, insurance, marketing, etc. In Alberta, for example, hard costs are like 60 to 70% of the total pie, like the actual metal and wood and concrete. In Toronto, like it's below 40% sometimes, because the development cost charges can be 10 or you would know better, Ashwin, but 10 or 20% of a pro forma. Land is approximately 5 times more expensive per buildable square foot above grade. And it just is really difficult, right, to develop housing in those markets and make money. So I think, in Alberta, land is like 10% of a pro forma, maybe. It might be 20 or 30 in Toronto. But I just wanted to mention that. I think there's going to be a lot of population growth to markets that are less expensive for construction.
I think on that, to your point too, like I guess the excluding costs, when I look at the environment, I guess in different areas, one thing we've noticed is in BC, it's one centralized provincial agency, like BC Housing kind of administers all of their affordable supportive housing dollars. In Ontario, it's downloaded to municipalities and much more spread out. And sometimes we find, I guess, alongside that cost piece is, the counterparty. When you're working with one centralized agency, sometimes you may be able to strike something a bit different. In Ontario, it's hit or miss, depending on the municipality and their focuses at the time. You could be able to get something that shifts those, that helps manage those extra costs or whatnot, right? Depending on where you are.
Good. Okay. So another question that has come in here is, what type of housing is needed most and works best for maximizing impact? Low, mid, high rise, townhome, single family? Graham, do you want to take that?
I can take a shot at that one. Yeah. Well, it's, I guess, dependent on the market for sure. But there's a book called Missing Middle Housing, and there's lots of research on that. I think that is probably the most in demand is for families, right? I mean, I used to live in Hong Kong and London, and like a lot of big families live in small apartments and stuff, but that's pretty foreign in Canada, right? So townhome construction is something that we're excited about, and I think has a lot of momentum in some markets. That's less feasible in downtown Toronto, can build townhomes, but I think that urban sprawl and the townhomes are going to be part of a solution for accommodating housing. And then within the more densified projects, the medium to high-rise densities, the unit mix is very important, right? More 3 bedrooms. That's kind of the feedback we're getting from a lot of our nonprofits. They've got huge wait lists for 3 bedrooms.
Yeah, missing middle housing is something that across the board, like missing middle from a unit type perspective, but also missing middle from a form perspective in Toronto, changing a lot of those single residential use lands to something where you can get up to 6 stories that is able to just provide a lot more density without changing much, quite honestly. But yeah, in terms of type of housing, we've seen it all from single family homes, townhomes to mid-rise, high-rise apartments.
Yeah, I think in Alberta, there's only, in Calgary and Edmonton, if you were to average those markets, only 3 to 6% of the rental inventory is townhomes. It should be at least double that. Yeah.
Okay. There is another question here wondering about the potential for, government RFPs related to building housing, much like you might have for, hospitals or some other infrastructure asset. I'm sure you Asher have participated in these RFPs, which can be highly competitive. I haven't actually even heard of a housing project put out to RFP, but maybe you guys have.
In nothing as similar to what we have in the P3 infrastructure space, but there have been RFPs put out that have kind of offered variations of it. There was a large project in Toronto where the affordable housing was meant to be developed as a DBF, as an example, within the overall master plan development. So I think we're seeing more and more of that sort of mindset making its way. But part of it is it's going to be a bit different, because it's not going to look like the typical availability based P3. There is revenue risk, but to your point, Graham, it's muted given low vacancies and wait lists and all that sort of stuff. But nothing that's been put out yet, to my knowledge. I think they're more, the RFPs are much more nuanced in this space. So from so far.
Okay. Another question here. Want the panel's consensus on risk associated with housing when compared to more ICI level projects such as hospitals, as housing typically has less complex systems associated with it, but in return are also less revenue generating product.
Makes sense. I agree with that thesis. I think the systems in housing are definitely less complex than complex infrastructure. With respect to, I guess from a return perspective, I mean, with a lot of these hospitals, again, the revenue profile, the equity profile is a bit different. But I do think there's a middle ground there where the product that we're actually building, once we kind of standardize, what standard are we trying to hit, net zero carbon or 25% better than NECB or whatever it may be, those are much more repeatable, less risk included. And I think when you look at it on the spectrum, we're getting closer to that infrastructure type of profile, to put it simply.
Yeah, and go ahead, Graham.
No, I think that's right. I just, yeah, I mean, it's they're less complex for sure. I would not build hospitals like EllisDon, but I can imagine that being quite complex. The rental demand is pretty constant, right? And so you would be just to find markets where vacancy has declined lower than 90%, 92% probably in Canada. It's always leased up. Rents fluctuate for sure, but from a risk profile, we always count on the rents. I think there's a lot of risk with respect to construction costs. And when you can do it in a vertically integrated way with some of the synergies in the public-private partnership, those are mitigated. But if I look at the returns that we're trying to target relative to conventional infrastructure, we would probably be higher. We would be in the low to high teens on an IRR perspective versus infrastructure in maybe high single digits. Those vary obviously, but those are good risk-adjusted returns, and I think should be compelling enough, to your point, Ken, to mobilize a lot of private capital into the housing space.
Yeah, and I think it was Ashwin perhaps that made reference to the continuum of housing, where on one end you have housing at full market, and then at the other hand and you have maybe it's the hospital, right, or long-term care, where you're not just housing people, you're housing them and caring for them. And yeah, of course, right, like the system is way more complex, which means way more operating risk and staff and systems and all those things. But to be clear, what we're talking about here is housing people. Now, there's great need on, I think, assisted and supported housing and long-term care as well. Maybe that's the subject of another discussion, but to be clear, what we're talking about here is mixed market housing, where you're housing people that otherwise can't afford a roof over their heads. So listen, look, we're just about at time here. Guys, thank you so much for attending today. There are questions we didn't get to. I apologize for that. We will certainly follow up afterwards. And let me finish by saying, you know, I really think that this could be a solution for addressing the crisis at scale. And what we really need here are, you know, more projects and more capital to support the creation of those projects. So tell your friends, spread the word, get involved. We're not hard to find. So if you want to follow up on this discussion or have more questions at a later date, we're easy to find. LinkedIn, we have websites, you know, not hard to find. So thanks everyone for joining, and we'll see you again on the next edition of Frankly Speaking.
Thank you.